Welcome everyone to the Capital 101 Debt Panel. My name is Maria Galino from ICIC, and we'll be starting in a couple minutes. But before we start, I did want to just go over some housekeeping rules. Please go ahead and rename yourselves to your company name and your first and last name so that we can identify you. And please make sure that you're on mute throughout the session. And also, we encourage you all to turn on your cameras so that we can encourage everyone to turn on their cameras. Well, then let's get started. So I am excited to introduce Karen Kelleher, the Executive Director of Local Initiative Support Corporation, which is otherwise known as LISC Boston, who will be leading us throughout the session, as well as introducing the rest of the panelists. Karen, take it away.
Thank you so much, Maria, and welcome everyone. It's great to see all your faces. I understand you just, some of you have come from the Shark Tank, so I hope you're coming with lots of inspiration and ideas for your own business. This panel will talk about non-traditional debt sources. Debt can be challenging for emerging organizations and entrepreneurs to qualify for, and we have a great panel of three really dynamic debt providers who provide different types of financing to businesses that are hopefully like yours. So we're looking forward to hearing from them about how their capital options are different from what you might find in the traditional market and how they try to meet their borrowers where they are and provide the kinds of supports that help drive your success. So without too much further ado, I'll tell you just a little bit about my organization, but then I'm going to quickly move on to introduce our panelists and have them tell you a little bit about theirs. I'm with Local Initiative Support Corporation, as Maria said, or LISC for short. It's a mouthful. Otherwise, we're a national organization, one of the largest community development support organizations in the country with very deep local roots. And we have 36 urban offices like the one that I operate in Massachusetts. We're based in Boston, but we serve the whole state of Massachusetts. And we do lots of things, but it includes financing for small businesses. And we have a particular focus on businesses of color and really trying to create opportunities to build wealth for entrepreneurs of color. We, in our Boston office, do lending using our national products. We also have an affiliate that does SBA 7A lending, and we provide a lot of technical assistance support in a variety of different ways, but I won't go into that. I'm going to pass the torch to my colleagues on the panel to tell you a little bit about themselves and the lending products of their organizations. And we are going to start with Kim Folsom, who is the CEO and co-founder of Founders First Capital Partners in San Diego.
All right. Well, welcome all of you. I'm delighted to be here. Thanks, Karen, for the introduction. As Karen mentioned, our organization is Founders First, and we have both an accelerator, which is a nonprofit, Founders First CDC, and also our direct funding arm, which is Founders First Capital Partners. We too are a national platform, and our mission is to fund and grow diverse founder-led businesses to take them on to being the path of mid-market companies. How we view this, what we do, is a little from a slightly different lens. We don't view ourselves as just the traditional debt. We view what we do as a hybrid between traditional debt and equity. Our funding model is revenue-based funding. So as you are familiar with debt financing, where generally it's based on your personal and your business profile. And then equity is based on the perspective where you're selling an ownership in your business, a significant ownership in your business. And the investor is expecting a significant multiple, 5 to 10 or more return. Our model is revenue-based. If you ever watch the show Shark Tank, Mr. Wonderful, the bald guy in the middle, he uses the revenue-based model, and that's what we use. So basically, we take a interest as an investment in the revenue growth of your fund. The way that's it's paid back is to a cap that can be anywhere from 1.5 to 2x over a period of time. We are not looking at significantly your personal assets and your personal credit profile. We look at the strength of your business, the revenue streams, your gross margin, and those particular things, and your prospects to grow to be a mid-market company. And one thing that I'll share is how I came to this is I look at what I do has been on the other side of where you are as a founder. Founders First is my 7th business. My prior 6 were all tech companies. I had the opportunity of raising over 30 million in venture. And if I had to do it again, I would have liked to have been funded by somebody like me because I didn't have to give up as much equity in order to grow my business. So looking forward to the conversation.
That's a very pointed way to make it clear the value of working with a non-traditional lender or capital provider, Kim. So thank you for that. I'm going to move on and ask Kevin Gremse from, sorry, Kevin, I'm just blanking on the name of your organization, which is terrible moderator work. Kevin's with National Development Council based in New York, but working throughout the country, and he's going to tell you a little bit more.
Good afternoon, everyone. Happy to be here. I wish I could see all of your faces and be in person, but we're living in this strange age. NDC, we're a national nonprofit. We're a financial lead intermediary and a technical assistance advisors. We work mostly with municipalities, local development organizations, and nonprofits. We were founded 50 years ago with a very simple mission. The simple mission is to increase the flow of capital into underserved areas. The way we do that has changed over time, but we do that through a lot of different platforms and levels. So we serve a lot of different roles. We're a developer, we're an investor, we're a lender, we're an instructor. So we're doing a little bit of many different things in the communities in which we work, but we're here to talk about debt. So I'll discuss mostly our lending programs. We're both a lender through some of our Cdfis, and then we work with a lot of municipalities and help them design their programmatic initiatives, lending and technical assistance to be responsive to the marketplace. So how we lend, we have 2 different Cdfis. We have a Cdfi, the first one we created about 25 years ago. We're a small business lending company, so we participate in the SBA 7A loan guarantee program. The beautiful thing about 7A loan guarantee program, it's flexible. You can do working capital, you can do fixed assets, you can do refinancing of debt. And we see refinancing of debt is really important for a lot of younger businesses that have not properly aligned their sources and uses. I
think Kevin may have frozen on us, unfortunately. Kevin, can you hear us? Maria, I don't know if maybe you can try to connect with Kevin and see if you can help him fix that. While that's happening, maybe we can say hello to Oswaldo Acosta, who's the President and Executive Director of Cdfis Enterprises based in Washington, D.C. Oswaldo, welcome. Tell us a little bit about yourself and Cdfis.
Thank you, Karen, and we'll wait for Kevin. If he comes back, we'll let him finish his presentation. My name is Oswaldo Acosta. I am the Executive Director of Cdfis Enterprises. We're based here in DC, in the Washington metropolitan area. We have 2 capital tools available for small businesses launching or seeking additional capital. One is a line of credit, and the other one is a term loan. We are a lender in the traditional sense, but we are a non-for-profit lender, and we provide a solution that is not available in the marketplace, nor in the mainstream marketplace, which is capital that is more flexible, as Kim said, or she suggested. We have a different way of analyzing the capital proposition without putting too much emphasis in the personal asset or the credit history of the individual, but rather looking at the potential of the business. In that sense, we're an alternative lender. We still require collateral and look at all the parameters when you come to apply for a loan, but that's pretty much our way of doing transactions. I come from the micro lending world. I used to lead the lending of a small micro lender up to $50,000 here in DC, the Latino Economic Development Center. Now I lead the larger organization, but the ethos of our place is to provide capital to individuals who cannot go to the bank or cannot access low price capital through the online marketplace. Just like Kim as well, I come from the startup world. I'm an economist by training. I came to the US in 2004 working for the World Bank, and I launched a company in 2007 at the very eve of the Great Recession. And then I was able to get two transactions, two loans from banks, and then the world changed, and a Cdfi, a community development financial institution, which is a certification from the US Treasury, gave me many loans until I was able to exit. So I sold the company to a large corporation, and then I remained, after the exit, I remained committed to make access to capital my way of life. And I would love to be able to answer any questions that you guys have. These are challenging times for anyone who is in business, let alone who is in small businesses. And also, just like when I started the company in 2007, 2008, I think the reason why I was able to survive was because of the opportunities that opened up in the midst of a crisis. Businesses are being reinvented, models, consumer patterns are new, and all of you, the people that are joining to learn more about capital, are entrepreneurs by nature, and I'm sure you're looking 24 hours a day for options where windows and openings are being born. Okay, this is a new business opportunity that didn't exist. So I think this is a wonderful time, despite the challenges, to be an entrepreneur at any stage, because the landscape is changing, and that's when new ideas and new businesses are born. So the linearity of our world has stopped, and this is kind of an earthquake in the business sense. And I think that's why I think it's fascinating if we're able to seize the opportunity in the moment, and whatever you were doing, if you can pivot, to use an awful word, you will be very successful. And that's what we're doing now, trying to find those impressive ideas driven by the energy of individuals with proven success or are new in the business. And we say yes without even thinking twice. And that's what we're doing.
So Oswaldo, thank you so much for starting us off with those inspiring and encouraging words, because there are so many challenges associated with this moment, particularly for small businesses. So really thinking about the long game and the fact that there are new opportunities and a completely new marketplace that's being created as we speak, and is great inspiration. Maria, has Kevin been able to find his way back to us?
Yes, he'll be joining us shortly. The electricity in his building got cut off, so he'll be coming back on shortly.
So while we wait for him, I'm going to make you guys participate a little bit. We can't see you all at one time, but I'd love to know, are you looking for capital right now? If you know how to use the reaction buttons, just put like thumbs up or the clapping sign, either one, so that get a sense for what percentage of folks here are looking for capital, or maybe even just starting to think about capital. So I'm seeing maybe on the first screen, maybe a third or a quarter of the people in the audience are, but we've got a good 10 or 15 that are looking for capital. So of those, you can take it down and put it back up if you're looking for capital to finance growth. Anybody looking for capital to finance growth? We're just looking at magnitude. We're not taking names or anything. You can reach out to us, but so it's maybe a third or half are looking to grow, because maybe you see what Oswaldo sees. And then who's looking for capital to stabilize your business and or maybe pivot, which is somewhere in between, but we'll loop it in here to use that word that Oswaldo dreads. All right, so not that many are looking for that kind of capital. This is really a group that's looking to grow. Great, that's really helpful. So do we have Kevin back, or should we go on to the next question and we'll give him extra time to start from the beginning when we get him? Kevin, are you with us yet? No Kevin. Okay.
Here, we can continue on for now.
So let's go back to each of our debt providers and say, how is the debt product you provide? Let's get a little more nitty gritty. How is it different from what's available in the traditional marketplace? Is it cheaper? Is it better terms? Do you require collateral or guarantees? Do you provide any kind of wraparound support? How is your product different from what's available in the marketplace? What makes it, a better option for a business that's struggling to access debt capital? And Kim, I'll start with you again, if you don't mind.
Oh, certainly. Delighted to talk about this topic, just as Oswaldo was sharing. I founded Founders First based on my, opportunities and challenges with my 6 companies, of which I exited 3 of them, that it's more than money that you need to be able to grow your business. And some people may look at it from the standpoint of, well, I don't need capital, or I don't need growth capital. If you're happy with where your business is and you don't think that there's going to be any ups and downs, then that may be the right answer for you. But the reality is there's always going to be situations that are ups and downs, like Oswaldo mentioned about having to go through and operate in times of challenging markets. With my own entrepreneurial journey, I worked through 5 recessions. This COVID-19 is the 5th one. And I closed my first round of funding with my 5th company in 2008, March of 2008, when the market took a huge drop. So being able to understand and balance the whole capital stack is something that you need to do as a business owner, and that there should be multiple types of funding that you're going to need to do. Successful businesses pivot, regardless of whether or not you're in a recession. It should be that you're pursuing net new opportunities. And the way we look at what we do is we are a growth partner to the companies that we work with. Our relationship begins with our accelerator, where we meet the companies where they are. We work with companies as small, generating as $50,000 in annual revenue, to as large as generating $5 million in revenues. And we have 3 different programs that work with those businesses. And then the other section of our business, the other portion of our of Founders First, is we provide direct funding. But the expectations for our direct funding is that it comes with advisory support. It's not optional. It goes along with that, because we want to be able to grow these businesses so that they can be job creating 7- and 8-figure businesses. And they're going to need to make some transformation. So that's a given. So we provide advisory support throughout the term that until our investment is paid back. And that term can be 3 to 5 years. We are not the cheapest capital involved, but I look at it from a standpoint that we are smart money that's experienced, looking to partner with them. There are lots of cheaper passive funding that it's, you get this funding, you figure it out, you just pay us back, and you can pay us back in any variety. It could be by payments, it could be by taking your house, it could be all of those things. Our goal is to have a shared interest with the companies, and that's the way our revenue-based payback model works. And so, that's the way our model works. It's, they pay back a 1.5 to 2x cap in the form of revenue payments, royalty payments on a monthly basis. In addition to that, we provide advisory support. And so we meet with the companies, anywhere starting out a couple times a month, but it balances out to, it could be on a quarterly basis, to help them stay on track, connecting them to resources and supplementing what they do, so that we are able to help them grow. And through that experience, we have helped companies grow in multitudes from, 2-3x from where they started in our program. And so I'm going to pause there because I see that Kevin's back. So
that's great. Kim, can I ask you one just clarifying question to make sure we all are kind of clear on what this revenue-based financing model means? If my revenue isn't what I expect it to be, does that mean my payment is accordingly adjusted?
Yes, it is. It is tied to, this is where you get the shared interest.
Yeah.
and where we provide that additional support. So it's not like traditional debt in that you have a fixed payment regardless of what your ups and downs. We take into consideration that business, especially those under 5 million, are going to have lots of ups and downs. That's the way business is. And as our advisory support, our goal is to help them grow and find additional revenue streams and partners. So that increases their revenues, and as their revenues increase, their royalty payment increases, which by paying us back. Unlike equity, they don't have to sell their company in order to pay us back. They pay us back in monthly payments tied to a percentage or royalty payment of their revenues, whatever they are. So
Yes.
if your revenues happen to be, 100,000 one month, it's a percentage of that. If it's 50,000 the next month, it's a percentage of that. So it is flexible because we recognize that that's the nature of business.
Thank you so much for clarifying that. Do you require a guarantee or collateral for that loan?
We do take a personal guarantee. We do not require that they pledge any personal, assets, real estate, and that type of thing, because, again, this came from being a diverse founder that, if you look at most traditional lenders, in order for you to get significant 6 figures of capital, you generally have to pledge a significant amount of assets. We also focus on working with service-based businesses that don't have a whole lot of assets to pledge. And so our platform was designed to help those service-based businesses get access to growth capital that gives them a runway of 6-9 months or so. We also provide follow-on capital. So it's not one of those initial infusions of capital and then, you've got to wait until you pay it all back. We want to be as flexible and a smart growth partner like a good equity investor is, but we don't take a ownership stake in the company.
Thanks so much. I think it's really helpful to explain that revenue-based financing model. It's unusual and not traditional. So we're thrilled to have Kevin back. Kevin, we're so sorry. We had to continue a little bit without you, but welcome back. We want to come back to you and let you finish introducing yourself. And we're just digging in a little bit more, and maybe you could go right there and describe the debt products that you have available for small businesses, including sort of how the terms are different than market lending. You're muted, Kevin. Are you able to unmute yourself?
Yeah. So sorry about that. I'm working at a shared workspace, and it's not my traditional home of my office. And little did I know, in the shared workspace, some of the people here just says, "Oh yeah, we have problems with the internet occasionally." So I just found that out. But hey, it's something I'm always learning, and I always ask the businesses with whom I deal with this, hey, give us an example of how you encountered adversity and how you dealt with adversity. So I had a little bit of a challenge with adversity a few minutes ago, but I'm glad to be back. So yeah, I think I was mentioning the fact that we're an SBA lender, and SBA is a little bit more of a traditional credit facility, but we work in partnership with our municipal clients and nonprofit communities to do the SBA lending that is a little bit more challenging and smaller in nature than some of the SBA 7A loans that the banks do. And we're always looking for lending partners because in a lot of the structures, you see several different layers of debt, and lenders have become more open to do participation loans. So that one lender does a working capital loan, the other one does machinery and equipment. Every lender has limitations, and particularly CDFIs. A lot of the CDFIs out there, they're doing smaller loans, generally less than 200,000. Some of them do a little bit larger, but that's a good product to participate with the existing lenders in the marketplace. So it's always a good idea to look at multiple sources of capital, to look at options for doing layered debt. And then it's really important to have, the big buzzword that we hear, especially over the last 2 years, is economic development ecosystem. And I think that's an overused word, but it is important to illustrate that those of us who are engaged in community development lending, impact lending, it's really important to see credit facilities that are available at different levels of business stages. You want availability for micro lending for those really small businesses. And then you want the smaller loans that the banks don't want to do between 25 and 200,000. And really, usually that's the space of CDFIs. Our second CDFI, our community investment, community impact loan fund, we're looking at those smaller loans, less than 100,000. For the non-SBA lending. So there's a lot of different options, and it's really important for you businesses out there to really understand your ecosystem, to really get to understand what are your resources for available capital. And based upon where we are right now in this pandemic world, we have to look at different stages of capital. Right now, we're trying to make capital available for survival loans, stabilization loans, and then at some point, after many of these businesses stabilize, because their businesses are impacted for reasons they can't control, you also want to have at some point get them back to that growth capital. So we have, and we're participating with other partners to do a lot of the patient debt. So we're involved in a program in New York, and that's being used as it's being replicated in other marketplaces for this post-pandemic world where businesses need patient capital. So the terms of some of the programs that we're introducing is interest only for the first year, and then allow the loan to amortize after that runway of interest only. And then so it amortizes in years 2 through 5 or 2 through 6. And obviously the longer the better. From my perspective, the elements of good financing is longer term, lower rate, longer term, lower rate results in lower fixed payments, and then also matching the sources and uses. Because there's you have to consider you don't want to do 20-year loans for machinery and equipment, but to the extent that you can stretch out those loans for working capital, for instance, 5- and 7-year loans is a better alternative than 3-year working capital loans. And as Kim mentioned, the interest rate is not the most important thing, because for many of these businesses, just the accessibility is the issue, not necessarily the cost. And the cost is going to be a function of what's capitalized in the fund. And then also is important to matching the sources and the uses. And I mentioned before, a lot of businesses haven't done that well in the past, and they need to look at refinancing strategies so they can better structure their debt and lower their fixed monthly repayments. So that program called New York Forward, we're looking to replicate that in many other states throughout the country. And that's exactly what a lot of businesses need right now, is more patient capital. It's still underwritten as a debt. It's expected to be repaid. All of us CDFIs participating in that understand it's a higher risk profile. So when we create the program, we're creating larger loan loss reserves. And then indeed, a lot of the businesses just need grants. I've never been a big fan of small business grants, but in light of the situation that we're in, we're doing more administering grant programs with CARES funding on behalf of our municipal clients, and establishing selection criteria for the appropriate selection and vetting process for those businesses that get grants. The industry that is most impacted these days is restaurants. So a lot of our client communities are saying, hey, we want a grant program for restaurants, just to give them a runway, give them an opportunity to survive, so that eventually they can stabilize themselves and be operating normally again.
That's really great, Kevin. So we've got, I just want to kind of cast this a little bit, make sure we're level setting. So Kim's got revenue-based financing, which is really flexible, and the payment terms change with your business as your business is experiencing ups and downs. Kevin's talking about products that are structured very similar to traditional debt, but that might be cheaper, that might be more patient, that might be willing to go without payments for a longer period of time. And that might come with loan loss reserves in ways that we're taking risk with you that another lender might take, right? Kevin, you use the term CDFI just because this is let's define what a CDFI is. Can you just tell the folks what a CDFI is and what kinds of tools CDFIs get to help them make the debt flexible?
Yeah, the CDFIs are, well, the acronym stands for Community Development Financial Institutions. Those are alternative forms, alternative lenders that have a mission of making capital available in lower and moderate income communities. So there's got to be they have some level of accountability to lower and moderate income communities. And they're involved in, they're mostly mission-based lenders involved in lending for affordable housing, for businesses, and many of them prioritize businesses located in low and moderate income areas and for prioritize women and minority-owned businesses. So certainly we're all about lending in underserved communities, prioritizing women and minority-owned businesses. And that's the typical profile of CDFIs. There's a division of the Treasury that funds it, but you have to cobble together capitalization sources from private and public sources. And that's typically how CDFIs do it. So there's a limited amount of funding, and they're looking to leverage those funding by participating with banks. And then their primary focus is filling the capital gaps that exist in the marketplace, whether it be for real estate or for operating businesses. The industry has really matured quite well over the last quarter of a century that CDFIs have been around. There used to be, maybe 50 to 100, 15 years ago, but now there's I don't know, 400 to 500 different CDFIs spread around the country. So my advice to you is get to the access or get to know the CDFIs that are operating in your jurisdiction.
That's great. And Kevin's organization is a CDFI and LISC is, but we're very large CDFIs. There are also small ones, and you can just go online and there's a list that the CDFI fund publishes. You can search it by your state to find out who's in your state. Kevin, thank you. I hope you don't mind my interrupting there. I want to pivot to Oswaldo because we need to hear about the products that he's got, and then we can get into more conversation. Just for the panelists, I've been just reading the chat and people have been introducing themselves. Here's some of the industries we have represented, and maybe you can think about examples of businesses you've financed that might come up in the conversation that might be in these industries. Software, construction, cybersecurity consulting, there's a co-op grocery, a brand strategy business based on storytelling. I hope I got that right. Law, financial services, children's theater, and event planning. That's just the ones who said hello. So Oswaldo, passing to you.
Thank you. Well, our products are not very dissimilar to what Kevin explained. We are a CDFI as well. I would just emphasize that at the risk of saying what everybody already knows, that every single entrepreneur in America should know that the CDFI is a possibility for them to raise capital. It's not that you go to a CDFI and then you apply for a loan and boom, you have it. There are different levels of sophistication of local CDFIs. Some of them are more agile than others. Some of them are more strict in their underwriting procedures. But if you have a viable business idea, if you live in a metropolitan area in the US, and your credit is not stellar, but okay, you will have access to capital. It's one of the hidden treasures, or one of the best kept secrets in the small business world. There is this thing from the US Treasury. It's public money. We're heavily subsidized by US taxpayers. Therefore, it's a public good. And we, as an industry and the public policy makers, are part of the could be part of the solution as well. We don't make a good job kind of socializing the brand or socializing that avenue to access to capital. But I think that we all need to be aware that is a possibility. So the kind of lending we do, just like many other CDFIs, we're only making loans here in DC and Baltimore. But what I'm going to say is just pretty much applies from CDFIs in North Dakota to San Francisco, Los Angeles, and Miami, which is we fund transactions from $20,000 to $1.5 million. That's kind of our range is pretty wide open. When we look at the business, we look at all the obvious, but we also look at the character of the individual. We look at the financial statements. If there is a history, if there is a business plan, that is a plus. It's not needed. We don't require a business plan, but if there is a business plan, we obviously want to scrutinize and know how much you know about the industry, how much you've done your research. if you have had a history of as an entrepreneur, have you been successful? Why have you failed? Why did you fail? So one of the reasons why this business is very hard to make loans, to make profitable, or to scale the business of a small business lending is because to make a $20,000 loan, you spend $10,000 in staff, in human capital. That's why not even with all the promises from the fintech companies 10 years ago and all the big expectations, they have not been able to do it because it's very hard to find the right person. It's impossible to discern who will succeed and who will fail without spending 150 hours talking to him and his cousin and his wife and learning about the financials for the extended family. And that's what we do. And for us to do it, we get a lot of subsidy from the government. But I think that plays a big role in American capitalism to provide access to capital to people who don't have the right family or the right friends and or the right inheritances from their parents. So what I would say, what I would encourage everyone to do, if you are in business, if you already have a business, pre or post-pandemic, whenever you started, is to have all your documentation ready, your financials, your certificate of occupancy, your business license, your business plan, if you have one, updated, because there are hundreds of opportunities for grants. We're also, like Kevin's organization, we're also managing grants on behalf of the District of Columbia, and there will be more in the next 2 or 3 years. This calamity is here to stay. Yeah. Luckily, U.S. policymakers understand that we need to channel or kind of transfer some funds, not only to big corporations, but also to small businesses. And one of the main lessons, I know we're going to talk about this, but I'm kind of moving away from the issue of lending, but I don't want to miss the opportunity. One of the main lessons or surprises to me on this during this episode is how many small businesses do not have all what it takes to take advantage of opportunities when opportunities arise. I'm sure you've seen that in your own jurisdictions, Kevin, that you just cannot distribute funds because people don't have the ability to check all the boxes when it comes to requirement. That would be number one. And in the process of doing so, you also will have all the documents you needed to apply for a loan. So be ready, because opportunities will continue to happen either in the form of debt or in the form of grants. That's a fact of life, and it will be for the next 2 years.
Oswaldo, thank you. That you have a knack for bringing it down to the practical and the now. And we have a very practical question in the chat that I want to pose to the panel, because I think maybe there's often a lot of people in this position. And Cheryl, I'm going to put Deptowicz Diaz. I hope you don't mind if I'm butchering your name. I'm just going to paraphrase your question, but new business owner, never borrowed, but now looking to grow to scale. I don't know what I don't know or how to think about how much to borrow. And even if I should, I tend to think suffer in smallness if you can afford it. How do you think about starting the process? You don't know what you need to walk in the door. Should you just reach out and find one of these Cdfis or one of you and start to have a conversation? How do we start the process if this is our first time trying to borrow? It's a jump ball.
I can take a first stab at that, if you don't mind. And I will blend my own personal experience and my experience as a lender. And I will draw from what is happening at the macro level with big startups. I think one of the reasons why I was successful was because I had to be frugal and creative and had very little access to capital. That forced me to be very resourceful, creative, and more importantly, the mistakes I made, which were many, were not lethal. Because I made a few mistakes, spent $10,000, $20,000 here and there, I was able to recover. That's an important lesson. I can think of WeWork, for instance. Those guys got billions of dollars, and that was sort of they were victim of their own success of raising capital. They will never be able to recover. And there are many other companies. Of course, we're not talking about large unicorns now, but I think that's that's a lesson there. It happens at the small businesses as well. The other thing that I would that I have learned from as a lender is that if you come to me and you have the ability to borrow $20,000 from us, and you said, I want them all because I need the $20,000, I'll find out I'll figure out what to do with them, as opposed to getting $10,000 only. Do whatever you have to do at the more conservative scale. You are more likely to be successful to come back to us and get $40,000 if you performed in those $10,000 later, as opposed that if you get the full amount of $20,000 now, you struggle to pay us back, you made a few mistakes, you cannot recover, you lose credibility, and you're done with us. So in that sense, there is nothing better than a borrower that comes back with a success story in 6, 7 months, 10 months. We're also looking for borrowers all the time. We're also trying to find clients that are viable, that are scarce in the business. So when you are a client who has performed in a $5,000 loan, a $10,000 loan, you are golden to us. It's like, oh, this is the guy we want Peter to make, to borrow more from us because we know he's performed. So I'm not asking you not to be ambitious or think big, but be cautious, borrow the minimum you need, do whatever you have to do, execute, come back to us and say, I need more money. And I'm proven that I have the character, I've paid all my bills. So that's my advice. It's very practical perhaps, but just go slow. You will make mistakes, we all do, but hopefully those mistakes will not be fatal.
So Kim, Kevin, short answers. Let's try to get a little more lively conversation going here. What's your advice for that potential borrower?
So I always think of it as the founder's role, because I was a similar thing with a couple of my companies. Some of my initial money came from a Cdfi and did what Oswaldo mentioned about the $10,000 initial funding to work to different levels. You first have to start with the actual game plan of what are the outcomes or performance things that you're going to achieve so that you can get to the next stage. And that's where I think many of us have talked about accelerators that we have, so you can go through and figure out what's the path so that you can have the good outcomes out of that. And you're going to need to be, as Oswaldo's mentioned, resourceful. You need to be able to look at the strength of your business and the cash flows and the margins that you have, and your ability to, have some predictability around those elements. Because, as a first-time business owner, and also coming from a community that you may not have the friends and family to write checks to support what you're doing, you can learn from others as to how to go about doing that. And, the fortunate thing from when I started many of my companies is there's a lot more accelerators out there that can help you do those things than there used to be. And so, I would go through and do two things. One is look at what is the, kind of crawl, walk, run strategy of what can I get done in the next, 90 days, 6 months, 12 months from a performance standpoint. And then the other is what specific funding source that will provide me with not just an initial source of capital, but follow-on capital if I perform well. Again, it goes back to, you want a growth capital partner, not just someone who's going to write you a check.
Great answer. Kevin, anything you would add, and maybe anybody who has color on what do I need to bring into that meeting, right? Do I need financial statements, as Oswaldo said he likes to look at? Do I need a business plan? What about credit? How do you think about underwriting me and my business, and what kind of flexibility?
I'll touch upon that and really build upon what Oswaldo mentioned, is that you really have to have your financial statements in place, your historical ones and the interim ones. So right now we're in December, so the interim financial statements during 2020 are really important. You don't necessarily, and particularly where we are right now, you want to be able to use what has happened in 2020 to contrast with what has happened in previous years. So to have updated financial statements is really important for that first step. but more importantly, being able to articulate to your prospective lender your understanding of those financial statements. We don't like to hear say, oh, if you have any questions about my financials, call my accountant. No, we want the businesses to be able to articulate their financial standing and the difference between cash flow and profitability and understanding of not only the balance sheet, but the profit and loss statement. So it's really important for the entrepreneurs, for the business owners to have that understanding of what's going on with their financial statements and be able to explain. And there's a lot of businesses that have decline in sales this year or weakening positions in their financial statements, and we want them to be able to articulate that in the story. The story is a really important part. Give us a story about why you need to borrow, because there's too many businesses that think a loan is going to be the problem, is the answer to their problems. But sometimes borrowing more money can get businesses into deeper trouble. So we really want to understand the reasons why they want to, and that's what we call the story credit. For us Cdfis, we do different types of lending, but it all comes down to their character loans and their story loans. So we want to look at the individuals. They have deep and sound character, that what they're telling you is based upon the truth. They have a commitment for making the business a success. So we want to know how they've dealt with adversity, as I mentioned before. If they don't have the best of credit records, that's okay. We're not going to just do it based upon a credit check. But if you have weak credit, we want to understand the reasons why you've had weak credit and what you're doing to strengthen that credit profile and what you've done to work out those situations with your previous creditors. So it comes down to the fact that we want to have an understanding of what drives you as an individual in the business and be able to articulate that individually. And that's how we sum up how we do lending. They're story credits and character loans.
Thanks, Kevin. I think that's really helpful. I want to ask a little bit about advisory services and wraparounds. Kim, you have a particular model. And I think there's a range here. I don't know if Oswaldo or Kevin has sort of a set of advisory services that are available in connection with financing, but a lot of mission-driven lenders do, or alternative lenders do. Yours is a model where it's required. Others have, like LISC in our Boston office, we have an accelerator program that we ran to help minority-owned businesses come up with their pivot, but we also have a network of 40 or 50 technical assistance providers that we work with and kind of refer you to for, targeted assistance. If you're in the food business, we have a party that can do that. One of the pitchers, the May restaurant that just pitched in the Shark Tank, went through our COVID pivot accelerator and came up with some great strategies, but you guys all just heard that she's deciding to actually make a bigger pivot in this moment. So advisory services, how do you get them? If you're not, going through a program like yours, Kim, are there other ways to get that kind of support? And what is it? What does it mean? How are you going to help?
So there's lots of different ways, but the challenge is, as a first-time business owner, you don't know what you don't know. So either you can go and do this kind of, just be quite honest. Again, I always look at it as I'm a founder and I'm in the same shoes as the people that are, viewing this, is that, when you do it in the piecemeal method, you have to know the questions to ask because, it's assumed that you know the next steps. And if you can do it by going through, and it's hard because, you have three things. Time is a hard thing, but you need to be able to spend the time working on your business, not just in your business, in order to address and get to the next level. And so for taking the time to participate in accelerators, there's an interesting assumption, as I shared at the top of the session, I was a tech founder and, there is, an expectation that, there's predefined stages, pre-seed, seed, series A, blah, 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 blah. And there's stuff that you need to go to this to get to these particular steps, because the expectation, if you raise equity capital, is you're going to have some exit to pay back the return, the revenue to the investment and multiples to your investor. That level of staging does not, unfortunately, exist in the small business market. It's more of a standpoint of, you may go to a development center or coaching center and you're going to ask the questions and that's going to be enough to keep you sustainable. But the reality is more diverse founders are going to run their own business because of such consolidation that's happening. And so my view is encourage you to find out what are the top accelerators that I could go to. Not all of them are the same. Not all of them are startups. Take advantage of those so that you, and also ask with regards to those accelerators, give me some examples of companies that get to where I want to be. Because that's how you're going to learn from others. So our advisory or support services are on both sides. We start with the assumptions that we want to get business at more million, $5 million, $10 million businesses, but most business owners don't know how to get there, and we want to help them get there. And so there's the pre-funding, training, and then if we fund you, there's the advisory support on the other side. Not everybody likes it that way. Some people like to go through and have the ad hoc, I'm going to figure it out on their own, and that's fine. That's just not the structure that we work with. But that's the method. But I encourage people to at minimally have a coach or somebody who's running a business and doing something you want to do. You can even have informal coaches asking them, hey, I really love your business. These top 10 lists or top 100 lists, those are great sources to find people that are doing what you want to do, and that you can say, hey, who did you use as a mentor? Do you have 5 minutes to talk to me? But that can be another source of helping businesses if you want to do it in a piecemeal fashion.
Yeah, thanks, Kim. We had one definitional question, and I want to do a time check. We're about 8 minutes from the end of our time here, so I want to get your questions going. We've been pulling them from the chat, but we can people speak, or anyone can speak, right? Anyone can unmute and speak. So I want to let you guys ask some of your questions and get your voices into the conversation. What's an accelerator was the question. I'm going to just do a quick response. There's a range of programs that essentially put you through a set curriculum to try to help you grow your business, to accelerate the growth or stabilization of your business. And they have a range of different focuses. So they might be focused on a particular industry. They might be focused on early stage startup businesses. It might be focused on a growth stage. It might be like Kim's. I don't know if you consider yours an accelerator program. I think you do, where you're pairing the advisory services that are helping the businesses grow with the financing. If anybody thinks I haven't defined that well, chime in. And meanwhile, we've got some questions coming through in the chat. Someone did ask for contact information for the panelists. So I want to ask the panelists if you would mind, if you're comfortable doing so, put your contact information in the chat so people can reach out to you if they have questions or want to, follow up with you about financing. And then everyone can sort of pull that out of the chat. So there was a question from Terry Monroe. Terry, do you want to unmute yourself and ask your question?
Okay, hi there.
Hi.
Hi.
Okay, my question was, when you're starting out with the business, the first year you're, seeing if you can make income. The second year is acquiring the income, but you're not really showing a profit every single month because this is your second year. Most lenders, the ones that I've spoken with, they want an overkill of information for $5,000 to a $10,000 loan. They want bank statements, they want profit and loss, they want 2 to 3 years of your tax filing. And then there's cash advance people that only need to know if you can pay it back and if you have a bank account. Why are the requirements so high for the first 2 years of you doing your business? What's the expectation?
Panelists, anybody want to take that? Why do we require so much paperwork for a little loan?
I agree with that, but let me just quickly answer from my perspective. Well, the short answer is that you have two options. You can go to an online lender, not necessarily with cash advancers, but you can go to Lending Club or On Deck, and it will be easier and you can get the money faster. The way I see this, or you can go to a Cdfi and they can ask you a bunch of annoying questions and they will always come back with more. The reason why I would still choose a Cdfi, it's because once you establish a relationship with that Cdfi, if you get the $5,000 if you produce all the documentation that they're asking, which is obviously is feasible, you just have to spend time on that. You prove to be persistent and you establish a relationship, you will pay back. The other reason is, I think it's a more practical reason, is that you will borrow at 6, 7, 8% max. If you go to a CDFI, there will be no hidden fees. There are no tricks. They're pretty transparent and honest people. It's not always the case with cash advance companies and online lenders. They're good players. I'm not saying that they're all evil or bad, but that's one reason. If you go to a reputable CDFI, you know what you're getting. You know that there are not funny lines in the contract at the bottom saying we will get X amount of points or whatever tricks. That there is no transparency. That's why I think that's one of the main reasons. Relationship and pricing, those two alone are important. I think are worth the effort to just spend those hours putting together a financial statement. And it's part of an education as well. If you are forced to put a P&L and balance sheet, those things are a bit obnoxious, but at the end of the day, they serve a purpose, which is giving a structure to the way you're looking at the financial history of your company moving forward.
If I could add to that, the reality is that, there's a trade-off. If you go through and use a fintech lender, they may be faster, but it's going to be way more expensive because of the risk, because they haven't gotten to really know you and know your business. But the reality is, capital is the fuel that grows your company. So you're going to continuously need some sources of capital. So it's important to get in the habit of learning about preparing, getting properly prepared financials and supporting documentation, because that's the exercise as part of the growth. But I will also share that there may be you should look at multiple different sources to fund the growth of your business. Not always the most inexpensive money may be the smartest money. Not always the fastest money may be the best money, but you're gonna have to put the time in order to get the results that you want. And you also have to make certain that the people that you're dealing with are going to, there's an outcome and an end to this. And not just because of what they say, it's based on what they've done with other people that you know. You're a customer to them, and you don't have to go through a whole bunch of, brain damage continuously to get access to capital. And the more that you grow, the better you are to get access to capital. But earlier, you have to unfortunately go through a bit of pain to get some of that in place.
Well said, Kim. We have very little time left, so I'm going to take one of the questions, and I'm going to pick on you with it, Kevin, because you talked earlier about getting to know your ecosystem. And one of the questions is, how do I find out about an accelerator? And so the question is, how do you do that? How do you figure out what's available to you in your market? I put the list of CDFIs in the chat for anyone who wants it, but that's not, that's a very limited way to start that process. Any advice about how to find out about the accelerators, lenders, and CDFIs in your market?
Yeah, 3 suggestions. Number one, check your local small business development center. SBA has small business development centers scattered throughout many marketplaces. So contact your nearest one. The SBDCs is a function of who's operating them. Some are very good, sometimes not so good. But you give them the first opportunity to share with you some of the resources. What are the CDFIs that are operating in the community? And do they have a list of angel investors? Who's providing some technical assistance? So I think that would be one of your first calls or outreach. Secondly, you want to check in with your economic development office, whether it be the city, the town, the county. And again, that's a function of who the individuals are. Some are quite good, some not so good, but you want to give them the opportunity to tell you about the resources that are available to assist small businesses. Again, you ask them about the CDFIs that are operating. You ask them about if there's incubators or accelerators. You ask them to share the information. to understand the profiles of CDFIs, you could, as Karen mentioned, the Division of Treasury that runs the CDFI program is the CDFI Fund, and you could check out the cdfifund.org, and that gives you the list of all the CDFIs that operate throughout the country. Some have a focus on housing, some have a focus on businesses, some are focused on very small micro businesses, others deal with larger businesses, but you want to get to know and form relationships with those entities. And then look at other forms of capital, and some keep lists of the angel investors and other resources that could assist small businesses. We have grown as an industry in the community and economic development. It's a lot more sophisticated. There are a lot of resources and individuals and entities that could be of assistance.
Thanks, Kevin. Maria, can I invite our panelists to share final advice on the way out the door here, or shall we invite everybody? Can I do that?
We do have our CEO, Steve Grossman, closing.
I cannot do that.
Debate, so
I cannot take Steve's time. So I want to thank all of the participants in this conversation, starting with our panelists, but you guys have been a great audience with great questions. Oswaldo, Kim, Kevin, thank you so much for offering your expertise and your time. Kevin, if you haven't already, can you put your contact in the chat in case people want to follow up with you with follow-up questions or lending opportunities? And, you know, on behalf of myself, and I hope all the panelists, if you do have follow-up questions or you're not sure where to start, feel free to reach out to any of us, and we'll try to put you in touch with someone who can help you in your market or your industry and help you get a start. So thank you.
Great seeing you.
Thank you. Thanks so much. Bye-bye.
Bye.
thank you, everyone. Now, following this day, please go back to the event lobby, and you'll be able to see Steve Grossman's closing remarks, and also give your feedback about the session to the event lobby as well. Thank you all, and feel free to save the chat with the contact information. We look forward to seeing you in the event lobby.